This is the current federal tax developments for the week of June the 1st, 2020. Current federal tax developments are brought to you by your State Society of CPAs and by Kaplan Financial Education. I'm Ed Zollers, and I'm here this week looking at what's happened this week in taxes. And some of what happened this week is going to be a few developments with the PPP loans, but we're actually going to have a little more general, just standard old tax developments for this week, so that ought to be nice. We did have some activity in Congress we're going to want to discuss, plus a couple of other issues that came up. But hopefully, we had a relatively quiet week compared to the previous weeks, and that means I don't need to spend an hour talking about whatever's going on in PPP this week. We can cover that relatively quickly, so I don't think we have to worry that much about how this whole thing ran with the PPP program. So that's probably the good news. So let's go ahead and let's get ourselves started. And what we're going to first do is take a look at what happened in the payroll protection or paycheck protection program loan program this week. Now, a week ago, we had a report from the AICPA that we were going to get 30 different, or that the SBA was sitting on 30 additional questions for the FAQ. Now, they did get out, as we discussed last week, some additional interim final rules for the forgiveness calculation, but these questions did not appear. My guess is a key reason why the questions didn't appear probably has to do with the fact, as we'll discuss here shortly, that we have some potential developments coming in Congress and some changes. My guess is they're maybe waiting to see if those changes occur, and then if they do, that may change some of their FAQs, so they're not going to really want to go there right now. The other things that happened this week, we did have one particular minor update to an FAQ, and this particular update dealt mainly if you were concerned about the employee retention credit. And what it told us was that we could still claim the employee retention credit if we had fully repaid our PPP loan by May the 18th. This is really a continuation of what we had when we were looking at, the Ruth Chris situation, repay your loan, and if you did that, you could obtain the employee retention credit. The problem is that the SBA moved the first date, extended date to pay it to, was May 7th. They moved that to the 14th. When they moved to the 14th, the IRS and the SBA made clear that you would still be able to claim the employee retention credit if you paid it back by the 14th. Following that, the SBA moved the date to the 18th after releasing the changes we discussed last week. Well, now, of course, the SBA had moved it, but we didn't have a direct statement from the IRS stating that you could still get the employee retention credit, nor did we have one from the SBA. So what they did this week was they simply added and moved that date in their question and answer that talked about getting the employee retention credit. So yes, if you repaid the loan after May 14th, before May 18th, yes, you can still claim the employee retention credit. So if that was a bother, that was worrying you, we have an answer. Now, a really big thing that happened and what kind of put everything on hold for this week was that both the House and Senate started moving on doing bills that would change the payroll protection program loan program. In the Senate is where we saw the first action, and there a proposed bill came up just as they were getting ready to adjourn. And it got introduced but not voted on. The catch was that apparently they couldn't find enough senators who are basically, they at least had one or two, however many senators, that had some objection to the bill and would not grant it unanimous consent to pass. They needed that because they were trying to jam this in at the last second before they left for their Memorial Day recess. Now, they will be back from the Memorial Day recess this coming week, so we will have the Senate back again, and they may start working on things. But in the interim, the House didn't wait for them to come back. The House of Representatives actually introduced and passed by a 417-1 margin a bill. Now, let's take a look at the differences in the two bills, because the House bill and the Senate bill are different. The Senate bill would extend the repayment period to 16 weeks, while the House bill would extend it to 24 weeks. Now, in both cases, they're not increasing how much you could borrow. So bottom line is we're going to have to watch and see how the drafting goes, but apparently you would still have to maintain your FTEs or full-time equivalents and still have to have a no decrease in payroll now for 16 or potentially 24 weeks. The House version also, the Senate version also would allow you, I should go with the ones in order. would have allowed you to use your funds for personal protective equipment expenses. So if you're going to be buying, let's say, you have to retrofit your office when you're going to reopen, because if you followed this week, the CDC just put out some new guidelines for what they expect for a business if you reopened. And if you were following those guidelines, you may have to make sure that everybody has a mask that they're wearing while in the office. You may have to put up various, blocks, plexiglass blocks between desks to keep airflow from going. There could be various other things that would happen. Well, the theory is that, of course, the Senate bill would allow you to use some of these funds for that purpose. The House bill, though, does not have that position in it. Rather, the House bill, as I said, would reduce the max payroll or minimum payroll to 60% from the 75%. If you remember right, the 75% payroll was never in the actual bill. The 75% payroll came from the rules that the SBA came up with when they were talking about implementing the program. Well, the House would put now a percentage into the bill. It would say 60%. This actually proved to be a bit of an issue because at least Senator Rubio is objecting, saying that it's clearly not the intent, but the way it was written, it was very possible that Treasury would decide you had to spend 60% of the loan on payroll expenses or nothing would be forgiven. So he thinks it needs to be rewritten. Therefore, that kind of killed the idea of the House coming or the Senate coming back and just unanimously consenting to it. It also would add some special rules that would give relief from not getting forgiveness if a business was unable to reopen, unable to bring its employees back for various reasons. For instance, it talks specifically about maybe you're a restaurant and the state in question said you could bring people back, but you could only have 1/4 of the tables filled. I remember seeing this week the governor of Texas has said, hey, outdoor sporting events are okay now, but you can only have 25% of capacity. Obviously, it's a little tough. You're not going to bring in as many people with 25% of capacity. Your concession stands can be a lot smaller, fewer staffed, if you have only 1/4 of the people allowed in the facility that are normally there. So it could be that under those sorts of rules, the social distancing rules and other limitations, that it might prove impossible to bring the employees back. So the House would add some special relief that would let you do that. Now, of course, where we stand right now is the House has passed a bill overwhelmingly. That does put pressure on the Senate. At 417 to 1, obviously there was nothing so objectionable in the bill that anybody except Representative Massey of Kentucky felt that they should vote no on the bill. And I suspect he's just voting no because, he was against the concept from the beginning. So bottom line, we basically had it virtually unanimously out of the House. But it does mean that the Senate will probably come back. My guess will be this week. They will come back. The Senate may very well propose they could just pass their bill and then go to conference, or they could end up, just trying to make some minor tweaks to the House bill, officially go to conference. But obviously, you can skip conference if the House will just pass what the Senate passed. So bottom line, we may see a bill later this week. If we do, there may be changes to the PPP loan program. Well, that's where we stand. So let's go ahead and move on to our standard developments this week. And this week we got, again, the IRS loves the website, loves frequently asked questions. We got some new questions and answers about NOL Carebacks of C Corporation. And the problem with it is, that, and this went up on the 27th, is that we now are having losses, NOLs, and they're coming from years 2018, 2019, 2020, where the corporate AMT did not exist. Now, under the Tax Cuts and Jobs Act, this wasn't a problem because we never could carry back from those years. But if you remember in 2017 and earlier years with the corporate AMT, you had to worry about the alternative tax net operating loss. You had to both do a carryback of regular tax and, to calculate that. Then you also needed the alternative tax net operating loss because that would impact how much the minimum tax dropped. Well, what they've decided is they're going to try to work this up. So the question becomes, I have 3 years, there is no AMT. What is my alternative tax net operating loss? And the IRS concludes in the FAQ that ATNOL is actually 0. So the ATNOL will be nothing. So when you carry back to those earlier years, you're going to take an NOL back, and you're going to have, for alternative minimum tax purposes, you're going to add back the regular NOL you took from that year, but you're not going to subtract any other NOL. That suggests that you may very well find in many years you'll get rid of the regular tax, but you'll still have the minimum tax sitting there, and you'll create a minimum tax, which will, on paper, also create a minimum tax credit. Now, we'll get into how all that works here in just a second, but you know what? We've known about this, and we've been able to file these NOLs for a while. So the question becomes, if I've already filed 1139 or I've already filed 1120X, what do I do now? Because I may have just, assumed the alternative tax NOL was the regular tax NOL. I may not have done it this way, probably didn't. So the IRS actually says in this, and there's a reason we'll discuss in a second, why it kind of makes sense, because I suspect in many cases there'll be no difference. The IRS just essentially has told people, don't worry about it for right now. If we need you to do something, we'll contact you, but don't send anything else in. Now, why would they say that? I mean, we're creating these, we're creating this minimum tax issue. I didn't have that. I asked for all my money back from 2018, let's say from 2013, and now, there's minimum tax there, so I should have left $5,000 there. Well, the reason they're not worried about it is because, remember, on the corporate minimum tax, you always get an offsetting minimum tax credit to carry forward to future years. On the corporate minimum tax, we did not have the issue we did with the individual minimum tax, where we had, two types of differences to work from. And we worried about those that would eventually reverse, gave rise to minimum tax credit. The ones that would never reverse, like state income taxes, those don't give rise to minimum tax credit. But for corporations, C corporations specifically, because S corporations are not directly impacted by this rule, because S corporations are everything treated as if it was an individual, which means the individual minimum tax rules apply, and this isn't going to be impacted. Individuals still have alternative tax NOLs. But the C corps, they get this credit. Now, if you remember, part of what we got as part of the tax cuts or as part of the CARES Act was an acceleration of something in the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act recognized that we had these minimum tax credits, and how are we going to absorb them? Well, they basically put an accelerated over a few years period where you would get it all back even if you couldn't offset the regular tax. The CARES Act gave us a possibility of just saying give it all back to us in the first year if we make an election under Section 53E5. Well, what we're going to find out here is if you have this, you can actually, if you make that election under 53E5, you're allowed to recover your minimum tax credit on the Form 1139. Now, the IRS notes if you don't make that election, then you get it back over 2 years. And if you're getting it back over 2 years, then you would have to do a separate filing of an 1120X to take the credit, because only if you elect to accelerate are you allowed to use this particular 1139 method. That said, I suspect most affected C corps will elect to accelerate. I'm sure there may be some odd cases where you wouldn't, but I suspect most will accelerate. So in most cases, you'll be able to just do it on the 1139. Next piece of news was actually very welcome to a lot of practitioners. A lot of us have been waiting on this for a while. And that is that the IRS has announced that we actually are going to this summer, only for 2019 years, which is going to be kind of an issue, but still, we're going to be allowed to file amended returns. The amended 2019 returns can be filed electronically. Now, as you know, the CARES Act had a lot of things that retroactively changed the law. So the law was changed retroactively to put things back in, like, let's say, qualified improvement property got to be able to fully expensed. We got rid of the cap on business losses for an individual. So we have a number of these odd things that could require us to amend an individual return for 18 or 19. We got the change in business interest rules under 163J. Well, if we have to do 18, we will be able to now do that electronically, which could be very helpful because, again, the IRS, we've got to expect, is going to be backed up for a while. And as we all know, prior to this, e-filing was not an option for individual amendments. If you are amending an individual return, it had to go sit in that stack of returns in those trailers at the IRS Service Center sites. Now, the problem here, though, is we're probably still going to have to do a lot of those amended returns because remember, the promise is only this summer. And the promise is only for 2019 years. So there'll be changes to 18 based on the CARES Act because a lot of these changes affect 18 and 19. Those 18 1040Xs, even when they give the go-ahead for electronic filing, are not going to be able to be filed electronically in the initial period, and they didn't give us any idea how long it would take for them to go ahead and allow us to file the other years electronically. And frankly, all they gave us was a very vague notion of when we'll be able to file this particular set of returns, the 19 returns. All they told us for sure was that we'll be able to do it this summer. Now, let me remind you, summer runs quite a while. In fact, summer ends on September 22nd. So if they finally let us do this in the latter part of September, they would be correct under these rulings. The problem is that it would probably be later than you're going to want to wait to get these things run through. That said, we don't know how backed up they're going to be, so it becomes 6 of one, half dozen of the other. Do you file the 1040X now, get it on paper, and get it stacked somewhere in a trailer at the IRS Service Center and hope they get to it? Or do you wait until sometime this summer when we will be able to file electronically? Again, if we had a better idea, if they'd given us and said we'll be able to file electronically beginning, let's say, July 31st, that'd give us a lot better idea of whether we want to hold off and wait or want to file right away. As it is right now with the vague date, my assumption is we're looking at the latter part of summer, not the earlier part. And because of that, I would probably, if I had an amended return right now, I'd still file the paper version because who knows, we may get to later this year and they'll say, well, we had more trouble. Obviously, they're not ready to do it now. So they could very well tell us that, yeah, we're going to do that next year. And then you're just going to be even further behind the stack for getting reviewed. So good idea, wonderful when it's ready. But my own bias is if I had an amended return or I have amended returns to play with, especially since I'm probably amending 18 as well, I might as well get 18 and 19 in there on paper rather than hold 19 waiting for the electronic forms. Now, of course, I do that and it'll come out, basically June 30th, it'll all be ready to go. But okay, I wouldn't mind being surprised that way, but I'm not expecting to be surprised that way. Finally, we have Notice 2020-35. This came out on May the 28th of 2020. And the IRS, under this case, expanded the due date relief. If you remember, under Section 7508 Cap A, the IRS pushed back the time for filing a whole bunch of documents, returns, extensions, making payments. But there were still some things out there that hadn't been touched on the extension. So the IRS at this point went back and added a number of items that had been left off before. Specifically, this particular ruling is going to give us some relief for certain things related to employment taxes. Now, this is not everything with employment taxes. In fact, we're going to find out it's very limited, but we do have a couple of employment tax items that are in here. We're going to have a couple of things that affect employee benefit programs, and we'll talk about that. We have some relief for exempt organizations. And then finally, we have a special set of rules that will help entities that have to file Form 5498, 5498 ESA, and 5498 SA, right? All of those particular rules. So the idea is we're going to grant relief in general in that area. Now, this grant of relief is a little different than earlier ones. First part is it covers basically the same period when a date would have come in that would have been due. So if you take a look at that, we're going to be pushing most, but not all of these dates to July 15th, but it's still going to cover acts that needed to be performed from, that should say March 30th, not 20th, 2020, to July 15th, 2020. So we need to be looking at that. The bottom line is we're looking at events that should have occurred. So it's not going to help if one of these was, let's say, due on March 10th, you're not getting relief from this. This isn't fixing everything retroactively. But if the actual date would have fallen between the 30th of March and the 15th of July, then this particular notice, you want to go double check it, and see what's going on. Remember, though, the key warning: not every date got pushed to July 15th. In fact, we're going to find one got pushed only to June 30, another gets pushed to July 31st. We have different rules, so there's a lot of them. So if they don't tell you otherwise, then July 15th is your date to do it. But in many cases, you need to double check each one of these and see what the performance date really is that they finally allowed. So let's talk about what did we get for employment taxes. We got two areas of relief here. And if you're not a certified professional employer organization, really we got only one. There is a special set of rules that allows, in some cases, for an employer to make a modification, right, to adjust payroll tax payments and be able to do that within certain time frames and not have to worry about being charged interest on the underpayment. Well, we're going to essentially suspend those rules temporarily. And if you had a date that falls between those magic dates, you're going to be able to push it out after that date to July 15th and have it be interest-free. So, good news. I think a lot of us would find that. If you are a certified professional employer organization, a CPEO, CPEO's electronic filing requirements are being pushed back. In essence, you don't have to do it electronically. Okay, so it will say that 941s for the second, third, and fourth quarter of 2020 and 943s for calendar year 2020 in the schedules do not have to be electronically filed. The reason for this is fairly obvious. We are making major changes to 941s. My guess is the IRS itself is not even sure if they'll be able to get electronic versions up and running of these forms, and they certainly aren't sure that then the software, the payroll organization, will be able to get their software updated. So what they're going to say is, if you have to, we will accept paper versions from the CPEO, because they were required to do it electronically. We'll take those paper versions for the rest of this year. That allows the CPEO to, have at least until next year. Now we'll see what happens next year. We may go back to the standard rules, or we may go back to standard type form. That'd be the goal, I expect. Or if there's still problems, we may still have special rules and a more complex form. I suspect if we do, then we're going to find that the more complex form, we're going to still get this kind of extended relief after that. Now, on employee benefit plans, we have a few things that came up, and it's really kind of a potpourri of things. The first thing is there are a number of, and I see I hit too many things there, special rules for funding for defined benefit pension plans. And what they're going to extend is application for a funding waiver under Section 312, a number of rules for multi-employer plan funding issues, and a number of CSEC plan issues. All of those will be extended, so these all affect the plans. We also are going to get a waiver and an ability to delay the filing of Form 5330. Form 5330 has a number of excise taxes that apply to qualified plans and, in certain cases, exempt organizations. So you're going to be able to delay the filing of that and file it on July 15th, file it later. Actually, as I recall, we're going to be able to get a little more extension on that. So that's good news. Now, we also have one thing about qualified plans. We're constantly having to make amendments, and we always get extra time to do it. Well, we have some special problems because some of these periods for remediation were falling within the due date. So essentially, there was a pending initial remediation period for a 403B plan issue. Any of those that were involved, they will be able to extend that. The ones that they were talking about, their rules described in Revenue Procedure 2017-18 and 2019-39. The due dates in those two revenue procedures will now be pushed to June 30, not July 15, June 30. I told you some of these have different dates, right? We're also going to go back and we're going to take a look at the substitute mortality. Well, let's see. The pre-approved defined benefit plans. This is another case where we might have to have a ruling to adopt certain things and run them. These dates that fall due are going to be different again. Instead of the date being July 15th, this one goes to July 31st. So like I said, the dates are just different. So if you have the issues that are described in here for dealing with issues with pre-approved defined benefit plans, all of that, those relief, adoption of a pre-approved plan that was based on a 2012 cumulative list, and submission of a termination letter application of the second 6-year remedial amendment cycle, and actions that are otherwise required to perform with respect to disqualifying provisions during the remedial amendment period that would otherwise have ended on April 30, all of those are covered by this. So that takes into account those issues. Another thing we get here is actions to correct matters under various programs under the employee, let me get this right, Employee Plans Compliance Resolution System. I always just call it CPCRS, but it has a full name, so we're going to call it that. Those various actions to fix problems in plans are the various components. Remember, there's a whole series of things under this program. There are various levels. Any of those things that need to be completed during this time frame will again be timely if done by July 31st. So that will happen. Also, and this is one I thought it was on earlier and then I wasn't. You're going to get, in essence, you can make a request to use substitute mortality tables that was originally due between March 30 and July 15th, can be made by July 15th, and all will be well. So we'll fix everything. You'll be fine. We're good on that. There are a couple of relief provisions for exempt orgs, and probably the one that's going to affect, it's not going to be a big thing probably for you, but it's going to affect some of the clients you get stuck with because something's going on, and you find out, oh, they've got this little tiny tax exempt org, and they've been filing the e-postcard. Well, any e-postcard filings due during that period, March 30 to July 15th, will be timely if done by July 15th. They also patched a special problem here for exempt orgs, which is under Section 7428, an organization can file within a specified period of pleading for declaratory judgment with the tax court, court of federal claims, or district court for the IRS's determination or failure to make a determination regarding an entity's qualification to be an exempt org. Well, what it was, the last, you may have remembered, wait, we didn't extend dates? Yeah, we did, but we didn't extend it for other than the tax court cases. So this is going to clean up all of those cases. So we'll be able to do all of them again through July 15th date. Finally, we're going to have some special relief here for Forms 5498 filings, right? The 5498 filings, which will include the IRA contribution information, the ESA, the Coverdell ESA contribution information, and the HSA, Archer MSA, or Medicare Advantage HSA information. The due dates for those is postponed all the way to August 31st. So we have an August 31st due date. We'll be able, as long as you file these by August 31st, you will be fine. So, hey, I told you we got delays for some things. Well, yeah, we're shorter this week, actually. It's good news. We don't have as much happening. But we do have regular old CPE starting now, and I did want to remind you that the month of June, and I know a lot of states have June 30 renewal dates, so I actually do have a number of sessions going on this month. Now, not surprisingly, they are all webcasts. I will be doing sessions for the New Jersey Society on June 3rd and 4th. That pair of sessions will deal with trusts and estates on the first day. We'll deal with, actually the second day it deals with RevRec, and then computer security issues for accounting on the 4th. The 16th, we are going to be doing a monthly tax update, 4 hours. That's on there. We will update whatever has happened the last month. And obviously, a good chunk of that is going to be, if we get a new PPP bill, we'll do that. But also the forgiveness calculations and all those things came up with that time frame. So we'll take a look at whatever's happened in the past month and go over 4-hour session. Arizona Society, I will be there the 8th, 9th, and 10th doing sessions, and we'll have it on multi-state taxations of businesses on the 8th. The 9th is preparing complex returns. That session was originally scheduled to be held in Tucson. Obviously, live sessions aren't working too well right now. We have all these issues. So basically, that will be webcast. So it'll be a webcast session. On the 10th, I'll have both Arizona Ethics and Arizona Income Tax, 2 4-hour sessions. You can take those. Oregon Society, I'll be doing a bunch of courses, in this case, much more along the accounting and auditing side, looking at the FASB and auditing updates, looking also at revenue recognition, and looking at the lease accounting. At the Illinois CPA Society, I will be doing yet another COVID-19 tax update. That'll be June 23rd, picking up whatever we have to that date. So if you're a member of any of those societies, no matter where you are, we are in the world, I guess, we can do this webcast. You just be on a weird time zone. You can go ahead and pick those courses up. They are all webcasts. The details for signing up are at the individual state societies, so make sure you go there to find out. But we're going to be doing a bunch of those, and yeah, things are getting underway for continuing education. So this has been the current federal tax developments for the week of basically June the 1st, 2020. You can catch up with us online at currentfederaltaxdevelopments.com. If we do get a new bill, I'll probably mention it there, shall we say. I'll also mention it in my Twitter feed, so you can follow me at @EdZollers on Twitter. If you have questions, edzollers at currentfederaltaxdevelopments.com. I do discussions on Reddit at reddit.com/taxpros. I also follow state society discussions on the Arizona, Illinois, New Jersey, Minnesota, and Washington societies. So I take a look in there, and if I see a question, I'll try to respond to what's going on there. Also take a look at Cal CPAs, which is open to anybody, regardless of where you're a CPA. You don't have to be a member of Cal CPA to be in it. So also check in there from time to time. We may get a new bill this week. We may get major revisions to the Payroll Protection Program, and we'll have to talk about what they do and the consequences of that if they do. Right now, we still don't know if we're getting one of the two bills, if we're getting a compromise, or what we'll be getting, so it's actually way too early right now to talk much about what we're doing. But if we do have that, sure, expect to talk about that next week, and otherwise look at any other developments that take place in the next week in the area of federal taxes.